Assalamu alaikum friends, welcome to day 4 of AFM Division Crash Course. Earlier we have just finished International Investment Appraisal in day 3, and this here we are going to cover financing decision. Okay, so we are going to focus on the past exam history. What are some key considerations when one needs to raise finance? The WACC, very important. You are definitely going to get a question on WACC. Okay, 110%. Principal theories, static trade-off theory, packing order theory, gearing drift. Okay, gearing is like your debt. Then agency effect, equity financing option, dark pool trading system, debt financing option, Islamic finance, financial foreign projects, specific foreign financing options. Okay, these are specific because they are only applicable when you want to finance the foreign projects. Okay, so from the past exam history you can see that this question is mostly asked in question 3. Okay, question 3, and sometimes it has been asked in 1 and 2 also. First was discussion of financing option, most of the time it has been asked, right? Gearing has been asked, calculation as well as discussion. Okay, gearing means how much debt you have in your finance, how much of it is debt and how much of it is equity. The higher the debt, higher the gearing ratio. Discussion of gearing theories. Now there are some theories also. Okay, it has been asked once in 2021, March June 2021, and then we have factors the capital providers will need to consider. That means when someone wants to give debt, what are the factors they might want to consider? So these are the things. Okay, but it has been asked at least once. It has been asked, so you need to go through this. These are some key considerations. Okay, see, when one wants to raise finance, okay, the main thing is it has to be a optimal capital structure. What is optimal capital structure? Right package of debt and equity, right? Then we have, next is availability of sources of finance. Not all sources of finance are available for all the companies. Depends on your size also. Maybe some source of finance might not be applicable for small firms, right? Tax, if the company does not pay tax, remember, having debt will not give you any advantage. Why? It is the interest on that debt that is tax deductible. That means you are getting a tax relief. Remember, when you are deducting interest from your expenses, right? Then you deduct your tax. That means you are paying lower tax now because of the interest. It reduces your income, so you pay lower tax. That's an advantage, right? But if you're not paying any tax at all, like you are in a position of 0% tax paying, like you don't have to pay any tax, your income is very low. So even if you keep on adding more debt, okay, even if you keep on reducing interest from of that debt, and you're not paying tax, so it will not give you any benefit. So you have to be a tax paying person to get this advantage. Risk profile depends. How risk are you willing to take? Are you risk seeking or risk averse? If you are risk seeking, you might want to take more on debt. If you're not, you might not want to take. Then we have covenant. Okay, covenant is, it's like mostly this is given in your loan agreements, right? Or in your company's article of association, they say how much you can borrow, what is your debt capacity. Okay, that this is the limit. Once you go beyond this, you are breaching that covenant. Then you have to pay a penalty. Then you might have to pay higher interest, or you might not get that loan next time, right? Now comes the WACC. WACC stands for weighted average cost of capital. That means it's like an average for all the sources of finance that is used in the company. Only two sources of finance. One is equity, one is debt. But what portion of debt is used, what portion of equity is used, that is what WACC calculates. That's why you will always see your WACC is in between your cost of debt and cost of equity. Cost of equity will be the highest, cost of debt will be the lowest, WACC will be in between this two. Always. Okay. Debt is cheaper than equity. Know this. Okay. Why? Because it has lower risk. On the one hand, we might say yes, it might have higher risk. Financial risk is there because you have to pay interest. Obligatory interest you have to pay. Unlike dividend, which you if you don't pay also it's fine. But still, debt is lower risk compared to equity. Okay. You will get tax relief on interest on debt. This you will not get in equity because dividend is deducted after you deduct your tax. So no interest, no benefit. But finance risk increases the cost of equity. It is that finance risk of that debt. You cannot keep on adding debt as much as you want, right? After a certain point of time, finance risk comes there, right? So because of that, cost of equity increases. And your WACC also you will see will increase because of that. Because WACC is nothing but cost of equity plus cost of debt, right? If they increase, WACC will automatically increase. Now, these are some principle theory. You might be asked in the exam, you might not be asked in the exam. If you are asked in the exam, you have to know these theories. Okay? Yes, most of you might memorize it, but understand the logic behind each of this theory before you memorize. It will help you. Right? It's nothing difficult. Okay? So looking at the trade-off between cheaper debt and increase in financial, yes, debt is cheaper, but it increases your financial risk. So you have to find a trade-off between these two and the cost of equity. That is KEG. Okay. This is a traditional view of gearing. This is how traditionally people view gearing. Okay. That is that K is the cost of equity, KD is the cost of debt, and KO is the WACC. Okay. This is the diagram. You don't have to draw the diagram in AFM. Not needed. Do not memorize the diagram. Just understand. And if you see here, from this diagram, you can see KE is the highest. K0 WACC is in between KE and KD. KD is the lowest. Okay. It is same, KD is same after a certain point and then it keeps increasing. And X is the point that is like the optimal position. Okay. X is a point where WACC is the lowest. That's what you want, having the lowest WACC. It is at point X. This is the traditional view, right? Then we have what is known as Modigliani and the Miller with tax theory. This you have to know it. Okay. This theory says this. Look at the diagram how it changed. It they are saying because tax because interest debt is you are getting an advantage of having debt. Why? Interest is tax deductible. That means your cost of debt will remain the same. Just see, straight line does not increase. So because of that debt, your cost of equity, if you see, that is increasing normally, but your WACC is reducing. It's in between KE and KD, but if you see, it's reducing. It's right because it is in between KE and KD. It is in between KE and KD. Okay, but it's reducing. Earlier it was increasing. WACC was in between KE and KD, but it was increasing. Now it is reducing. Why? Because of the advantage of tax that KD brings, cost of debt brings. Okay. Again, do not memorize. If you're not understanding the diagram, just forget it. Okay. But understand that WACC is in between these two. Okay. Now, what's happening? As gearing increases, WACC reduces. Do you see? As gearing increases, WACC steadily decreases. Then, what? The higher level of taxation, the lower combined cost of capital. You see? So, the higher level of the company's gearing, that means higher the gearing, greater the value of the company. This is what they wanted to prove. Higher the gearing, greater the value of the company. So, theoretically, companies should choose a 99.9% gearing level. Okay. Or you can say 100% gearing level. Okay, anything. But there are problems. You can say that a company might have 100% gearing level also, if that's the case. Because you just told having High gearing means greater value of company. So in that case, you can have 100% gearing level also, but companies do not go for that. Why? Because having high gearing will bring other risk, like bankruptcy cost. Bankruptcy cost is there. After a certain point of time, you will become bankrupt. Second, agency cost. Not everyone is having the same risk profile. Managers might want to take different level of risk, investors have different level of risk, things like that. The banks might not willing to give you the risk at that, lend you loan at that risk. So it depends, risk profile. Tax exhaustion, there's a point up to how much you can exhaust that tax. You can take the advantage of tax, beyond that you cannot. Then personal taxes are there, yes. So all these things are problem. This will discourage the company from taking high level of gearing. Okay, you need to know these points. Then signaling to investors, as your gearing increases, okay, it keeps on increasing, is not a good signal to the investor, because they think you are relying so much on debt, right? Which is not good, because it increases your financial risk. From the investor's point of view, it makes you financially very risky, very risky. Then the static trade-off theory. Static means one point at time. What is static trade-off theory? There's a trade-off between the tax shield. See, because of that tax shield that you are getting for the debt, it increases firm's value, right? But on the other hand, just now we saw that there is a reduction in value also of that firm. Why? Financial distress, bankruptcy, agency cost. So you need to trade off between these two things: advantages versus disadvantages. Which is more? Second, firm assess this trade off in an attempt to find the optimal capital structure. So this is how firms will go for a optimal capital structure. They will see. Okay. So in conclusion, if bankruptcy risk is also incorporated in Modigliani and the Miller's model, it will give you the same position as the traditional model. What is that? Cost of equity increases, cost of debt will increase after a certain point of time, WACC also will increase, but WACC will be between these two. That's what traditional model says. Okay, but model does not say that. It's giving a different answer. Why? Because bankruptcy risk was not included in that theory. They are saying have as much gearing as possible, right? Then, so above the target, this is how you decide. Okay, above the target, you set a ratio. Okay, you just set a target that this is what I want my gearing to be. 50%, 30%, 40% is up to you. Above that ratio, you are going to face financial distress and agency cost. Here, cost will be more than benefit. If you are below the ratio, you can keep on increasing your debt up to that target ratio. Okay, this is the meaning of static trade-off theory. You keep it static, one point. At one, you just keep one target. So you keep on increasing and decreasing until you reach that target. If you are more than that target, you reduce and come to that target. If you are less than that target, you can increase your debt and come up to that target. You understand? Just see through this diagram. Okay, so you are in a static position inside that box. If you are lower than that box, you still have some chance to increase your level of debt. If you are above that, you reduce your debt level and come to that position, come to that box. Okay, so that's the thing. Now the next, pecking order theory. Okay, this all are theories basically on the way you decide your finance. Pecking order is easy. Pecking order means you choose an order, 1 2 3. This will be my first choice, this will be my second choice, this will be my third choice when I go for financing. So this is the preferred order. Number one, always firms will first choose from internally generated fund, the things that they have in the business, because this is the less riskiest. You don't have to wait for it. The moment you want, you just get it because it's there in your company. Second is your debt. Why? Debt is cheaper than equity, right? Issuing shares takes more time than having a loan. Third is new equity issue. It takes time and it's very costly. That's why equity issue is often the last, because you can see cost of equity is more than cost of debt. It's expensive. So remember this order: internally generated fund. If you have exhausted fully, then you go for debt. If that is also exhausted, then you go for new equity issue. Okay, but if you can use entirely your internally generated fund, you do not have to come to debt. You do not have to come to new equity issue. Okay, it depends from question to question. But this order you have to know. This order is known as pecking order theory. I mean, it's a theory, so pecking order. Okay. Now, investment. Value of a project will alter the choice of finance. For remember, it is the value of your project that will change your choice of finance. Okay. And why choice of finance is very important? Why are we even learning this topic here? Because your choice of finance will have a major impact whether you are going to accept a project or reject a project. Hence, investment appraisal came into the picture. Remember, investment appraisal, accept a project which is having positive net present value because it maximizes shareholders' wealth, and reject a project which is so that accepting and rejection depends on your choice of finance also. Why? Because even if you're having a let's say a project, okay, positive net present value, but if you do not have the finance to carry with that project, are you going to accept that project? Tell me. No. So even if it's a positive net present value, you're going to reject the project based on finance because you don't have finance. That's why choice of finance is very important. That's why we are understanding all this theory. That's why we are studying this topic known as financing decision. That's why this is very, very important. Then, higher geared companies with less cash may underinvest. From the point of investment, you will not invest as much as you could if you are a highly geared company and you are having less cash. Gearing is the next. Okay, higher the cash flow, lower the resulting gear. Remember, if you have cash flow, you will not go for debt. Hence, gearing will be low. Equity may be issued at a time of high information asymmetry. Okay. Then, decisions on financing should be governed by the static trade-off theory. Now, you have studied so many theories, right? Static trade-off theory, theory, pecking order theory. How do you know which theory to use? Which theory to help you to decide the finance? I've included this for you here so that this becomes easy. See, when the target is far from being met, okay, use static trade-off theory. Okay, when it is close to being achieved, when the target is being close to being achieved, use pecking order theory. When you are very far away from the target, use static trade-off theory. That means increase decrease based on the target ratio. When you are very near to achieve the target, use pecking order theory. This will help you. Okay, pecking order theory means internet general fund, debt, equity. Remember the order. You need to remember the order. Then we have gear. What we call as gearing drift. Gearing drift means what? See, profitable companies will automatically reduce their gearing. Okay, over time. Why? That gearing reduces only over time. Why? Because you have so much of accumulated profit that you can increase your value of equity through that. That means you don't have to rely on gearing so much. Only initially, later on, you have such a big accumulated profit that itself will help you to increase the value of equity. So gradually your gearing reduces. Hence it is known as gearing drift. It's drifting away. Drifting means it's going down, right? Gearing drift. This gearing drift can cause a firm to move away from the optimal gearing position. Remember, let's say you can have a gearing up to 30%, but because it reduces, now you're operating at 16%. You still have a 14, what did I say, 20%, right? Let's say you're operating at 14%. So that is not an optimal. Maybe you can reduce your WACC even further by operating at 20%, but you're operating at 14% because of gearing drift. So it moves you away from the optimal gearing position. Disadvantage is also there. Next, Firm might have to occasionally increase gearing. Yes, you sometimes have to occasionally do that. How? Maybe you are issuing more debt, you are paying a large dividend, or you are buying back shares to return to that optimal gearing position. Why do we want optimal gearing position? In the beginning of this, I told you, because you want to have the lowest WACC. Lowest WACC is possible if you're having the optimal gearing position, right amount of debt with right amount of equity, and hence WACC is low. Agency effect. When the level of gearing is high, this happens when level of gearing is high, mind you, not all the time. When level of gearing is high, interest of managers and shareholders conflict with the creditor. They are not aligned. They are not aligned. Okay. Managers and creditors, they both may act in way which is not good for the company. How? For example, by lenders imposing covenant. Because when your gearing is high, that is the time when managers are more likely to breach that covenant, right? And if lenders are imposing covenant, it's likely to get breached, right? That's why it's not good for the company. So the overall impact may encourage the use of retained earnings. Because you don't want agency issues, better to use retained earnings by restricting future borrowings, making new issues less attractive, right? Now, these are some actions that may be taken by the management when gearing is high, and restrictions that may be imposed by the lender. Number one, when gearing is high, managers, they gamble on high risk projects. Why? Higher the risk, higher the return. They gamble on high risk projects. Second, they pay large dividends. Third, they hide problems. They have to, because they have to comply with the covenant, right? Cut back on discretionary spending, yes, and invest in areas of higher risk than intended when the loan was raised. Loan was raised for some type of risk. You are investing in areas that is even higher than that for which you have taken the loan. Now, how do lenders restrict? They will restrict on the level of dividend that you can pay. They will restrict on the level of additional debt company can take. Ratio level, they will impose a ratio of gearing. They will restrict you from disposing major asset. Okay, so these are some things. Then we have equity financing option. These are some the main options for raising equity finance. Okay, main options. Number one, right issue, public issue, private placing. Okay, private placing and public issue, right issue is to the existing shareholder you are issuing the shares. Yes. Then we know what is known as dark pool trading system. For calculation, this will not be asked, but it has been asked for a discussion question, right? Theories. Understand what is dark pool trading system. Okay. Dark pool trading relates to the trading volume in listed stocks. Okay, same like normally how you trade, created by institutional orders that are unavailable to the public. The only difference is dark. Dark means it's unavailable. It is not available to the public. Okay, they trade in volumes, but it's not available to the public. Unavailable to the public. It's hidden. Okay, that is the meaning of dark pool trade, and this has the reason also that there's a popularity in dark pool trading now. Okay, meaning that information asymmetry becomes an issue of greater importance. Okay, information asymmetry means one party knows more than the other person, and hence they can take an advantage. It's like an inside information. Okay, debt financing option. This are if you want to go through debt. What are the options? Okay, remember, a company that wants to raise long-term finance, debt finance, they will be constrained by its size, by its debt capacity, and its credit rating. All matters. Okay, and the usual starting point for any business, where do you go for debt? For a loan, right? To the bank. Same. And this bank will give you that loan based on your business plan. Correct? And you can read more on this on your ACCA website. The title is Bond Valuation and Bond Yields. Okay, it covers bond finance. Please go and read it. It's very valuable, very useful, not only for this topic but also for your investment appraisal. Okay, because bond valuation has been asked in the exam, so please go and read it. Then, larger companies have additional options. They have bond issue, they have debenture issue, they have convertible bond issue where you can convert your shares to bond. They have mezzanine finance. Mezzanine finance have both the features of debt and equity. Syndicated loan. Please, you can read it detail on this, or you can just Google it and check briefly what each of this means. Detail is not required. Okay. Then let's move on to Islamic finance. Islamic finance, I would not say it comes all the time. I would not say it does not come also. It comes sometimes, it does not come sometimes. It has its way, its own way of, So, but know these terms, what it means. Mura, Murabaha. Murabaha means trade credit. Okay. In uh, in Arabic, these are Arabic terms. Okay. Murabaha means trade credit. You have to know certain Arabic terms for Islamic finance. What each of this means. Okay. Ijara. Ijara is an Arabic word meaning lease finance. Sukuk. Sukuk means debt finance. Modarabah means equity finance. Please do not confuse the two. One is Morabaha, one is Modarabah. Moda and Mora. Okay. Then we have Mushraka. Mushraka is venture capital. I'm sure you know what is the meaning of venture capital. I don't have to explain it. Further reading. Okay, there are two articles on ACCA website on Islamic finance. Please go and read it. Okay. Then we have, just know the difference. Okay, between your conventional financing and Islamic financing. Okay, in conventional financing, you can speculate. You can take on forward future to speculate. Options. Islamic finance says no, it's haram. Haram means prohibited. You cannot do any speculation. Okay, risk mostly whether straight credit or a bond is shared between the lender and the borrower in Islamic finance. That's the whole idea. Okay, but in equity finance, sorry, in conventional finance, you might be exposed to high risk. So just know there's few differences between a conventional financing and Islamic financing, because this is an area, only thing that they can ask on Islamic finance is that difference. Okay, difference between Islamic finance and conventional finance. Next, financing foreign project. When you're financing foreign project, thing is, are you going to borrow in domestic currency or foreign currency? Okay, number one. Number two, the foreign currency borrowing provides a hedge of the value of the project or a subsidiary to protect against changes in value due to currency movements. If you are borrowing in foreign currency, remember any changes to your currency movement will protect you, because you are borrowing in that currency, in the same currency as that project. Okay, it's like if you're supposed to get an inflow in a certain currency. Okay, let's say in your foreign currency or from the subsidiary, you're going to have an inflow invoice, right? Let's say, and it's an adverse movement, so your inflows are reduced. But what are you going to do? If you're having an asset in one currency, go and take a liability also in the same currency. So they both will offset. Asset and liability, the same currency will offset against each other. Hence, your risk will reduce. That is the meaning of hedging. You're managing the risk, right? So in that condition, you can have a foreign currency borrowing. Foreign currency borrowing can be serviced from cash flow arising from the foreign currency investment. Yes. Let's say you are having an investment in overseas. From there, you're having cash inflow. That cash inflow can be used to finance your borrowing. Okay. Specific foreign financing option. It could be for short term. If it's for short term, like euro currency, short term syndicated credit facility. Please go and read what is euro currency. Multiple option facilities are there. Euro notes are there. For long term, euro bond, syndicated loan. Okay, that's it for this. Uh, Thank you for watching, and the next video will be on dividend decision. We just finished financing decision in this video. The next one will be covering dividend decision. Thank you for watching. Don't forget to subscribe to my channel if you haven't subscribed yet, and please watch out the playlist. There is a whole playlist on AFM revision crash course. Right? I already have uploaded day 1 to 3, and this is day 4, and day 5 will be coming up soon. Thank you and take care.